microphone live.
I have two questions I'd like to ask. Mr. Hülsmann, maybe you pronounce his name, I could justly cast scorn on the old mindless anti-capitalist canard that greed is causing our problems. But I thought that Mr. Fritz seemed to be saying that a system of practices that unleashed, unrestrained greed on the financial system of the country. And that's one point. The second point, Mr. French began and ended by saying that banking is a form of embezzlement. Because depositors give their money into a bank as to a warehouse, and the bank then takes the money and uses it. But surely embezzlement can only take place if the person using the other person's money is using without his knowledge or consent. People don't deposit money in a bank as in a warehouse. They look around carefully for who will give them the most interest. They compare interest rates at different time durations. And it's to get the interest that they deposit the money, and nearly all depositors must understand that the reason that the bank is paying them interest is that the bank will use their money to make money for itself. So I can't see how it is embezzlement. So those are my two questions.
I didn't understand the first one.
You said you cast, I put just scorn on the old canard that greed was the causing our problems. It's mindless, populist, seeing nonsense. Greed is causing our problems. But it seems to me that Mr. French was saying that is what caused the problems. For a system of practices that unleash greed.
Well, I mean, he also stressed that the system of fractional reserve banks could not survive without government support, which comes in various forms, but most notably through the institution of a central bank. So if you didn't have government intervention in the banking industry, then fractional reserve banking wouldn't play a significant role in the first place. I think that would be the response.
Is that what you said?
Yeah, that was my primary point, that I began and I finished with the point that fractional reserve banking, essentially the lending out of customers' deposits, and again, these deposits are not loans. Most demand deposits do not draw interest. You put your money in a bank so that you can get the availability of it at any time. So I don't think most bank customers carefully consider what bank they're going to put in their money in. They don't consider the loans that the bank's engaging in. What depositors depend on is government force and government regulation of deposit insurance. That's what they depend on. They're not, if customers were doing their own due diligence, yes, we would have a much sounder banking system. But they're not doing that because the government has interceded with government regulation.
Given the distinction between good credit and bad credit by one group, there's actually any business at all left over which still provides legitimate banking services. Could anyone of you cite a positive example of an entrepreneur who really resisted those incentives which you described? In which field would you actually see the greatest potential and need for legitimate banking services?
Well, I mean, there were certainly many entrepreneurs, especially of small and medium-sized firms, who categorically refused to be financed with debt. I mean, it's amazing, but it still exists.
Banking entrepreneurs.
Banking entrepreneurs who systematically, well, I wouldn't know any. No, I don't personally know any example. But I mean, it's also true there that there are great differences in the way banks have reacted to the incentives coming from the monetary system. I mean, contrary to what we often hear on the radio and see on TV, it was not private institutions that were the greediest and the most reckless. But especially in Europe, it was German public banks, so WestLB, Sachsen-LB, and various others who were also first in line when the crisis hit Europe. So they had been handling the customers' money in the most reckless way. They were doing exactly all those things that allegedly only in the private sector prevails. And I would say so. The general rule is that the smaller the bank, the more sound was the management, the less they reacted to the incentives, because in fact they could count less on government support. They were not big enough. And the other thing is also that the same phenomenon if we look, for example, at hedge funds. And hedge funds have been diabolized in the media also by many economists, but the crisis didn't break out in the hedge fund industry, and the hedge fund industry is still not concerned. It's a very well-managed industry, and they had a smooth, up to now, more or less smooth deleveraging. So, and that's probably also because they couldn't count on support.
I know we had a savings and loan crisis in the 1980s in the U.S., and there were a lot of savings and loan banks that were very sound. The one I had my home mortgage with did not sell any mortgages, and so you had to have very good credit to get a loan, because they weren't going to just sell the loan to Fannie Mae or somebody. But our system is such that they ended up being taxed to subsidize the failures of their more irresponsible competitors. That's the system we had. So there are examples. And today, I know a banker personally, the CEO and chairman of BB&T Bank in the U.S. His name is John Allison. He participated in the lending boom, but he didn't make subprime loans, and he refused to lend money to any real estate developer who got land through eminent domain. So he's sort of tried somewhat to not participate in the whole racket, and so there are some examples like that. And his bank is one of the strongest banks in the U.S. right now, by the way.
There is a bank that has a very low loan deposit ratio, 22%. So they're just loaded with cash and haven't lent much out. So you would think, gee, here's an entrepreneur who saw the crisis coming, didn't overlend, and they should be reaping the benefit. They're not. The government has sanctioned them for violating Community Reinvestment Act. They're not lending enough money, and thus he's essentially in trouble with regulators. So it's hard to compete with an alternative business model to what's the typical business model is.
I think the Europeans in the audience need to understand that in the U.S. we have this act, this Community Reinvestment Act, that's been used for 30 years to essentially extort banks into making bad loans or subprime loans. It was all done in the name of anti-discrimination decades ago. But in 1992, the Fed admitted it had no evidence of systematic discrimination, racial discrimination in lending, but it enforced this anyway. And so it was sort of egalitarianism was the real reason. They wanted to make bad loans to low-income people just to force sort of a backdoor welfare state expansion. Rather than using tax dollars to expand the welfare state, they forced banks to make bad loans, and then, of course, now it ultimately is causing the use of tax dollars by the trillions to bail these things out.
I would like you to address the apparent schism in the Austrian school between Self-White, Seacrest, and their free banking, private with a contract. It's everybody's notified of the consequences. Okay, and the bargain camp represent that represents that there's a technical priority that has to be addressed with professionals who think. Recently, Self was interviewed by the Richmond Fed, and I was disturbed by this interview because that in March, the Scholars Conference in Auburn, where he received the Hyatt Award, and you guys were very polite to him. He making arguments on both sides, saying your arguments are very big for me. And I wonder, why is it that this division exists, and why it cannot be resolved?
Well, first of all, it's of course it's a very long-standing debate that reaches back, in fact, to the 17th century. And so it's a big debate that's been going on for centuries, and it was at a high tide in the 19th century, in the so-called debate between the currency school and the banking school. And what we are witnessing in our present day for the past 10, 20 years is a remake of the same debate, ultimately, with sometimes new arguments. And, well, I cannot tell you, I mean, why Selgin and White persist in error. You need to ask them. It's difficult to say. Well, all I can say is, from a scientific point of view, that's rather useful, right? Because you're forced to refine your points and advance. So it's good. I mean, even if we all agreed, it would still be good to have a devil's advocate. Then somebody would have to be picked out and say, well, Tom will now argue for fractional reserves. But so we can be happy we have Selgin and White. And sometimes they make good points, not always, but sometimes make good points, and then we go one further.
Yeah, I agree. It's a good thing that there's disagreement. This is not a church. It always strengthens your argument if you're forced to rethink how you articulate your position on something. So I wouldn't be too depressed over that.
I just want to comment that I'm not depressed about myself, but I do find it a little difficult to deal with the confusion that inherently creates as I try to complicate the message.
Well, it is economics after all.
But I mean, these days there's not much confusion, right? Because it's clear to everybody that there are at least two camps in this debate. There is a debate, and there are at least two camps. So there's at least it's clear that there are different opinions on this, which is better than to persist in complete confusion.
It's interesting to me that George's interview is with the Fed, defending the Fed essentially. That should tell you something.
I thought the contributions were remarkable, and thank you very much. And just to comfort what Dr. Strange was saying about the banking industry, it strikes me that when people buy an automobile or a computer or a high-fi set, they go on the internet and they look at all these forums where they buy magazines and so on to compare the various advantages and so on of all these consumers. But when they deposit all their savings in a bank, they do it just because it is around the corner and it gives a little and so on. And because it gives a high interest rate. And banks, because in the public perception, are all meant to be guaranteed by the government. There is absolutely no incentive for banks to communicate, to advertise that they are prudent. It won't bring them any more clients because people say, well, all banks are prudent because they're all guaranteed by the government. So they communicate on how can we give you something more, I mean, in the sense of high interest rates if you are a depositor or low interest rates if you are a borrower. So they are, therefore, driven to take more risk. And so I think there is a sort of flaw in the system there. The second thing, going back to what Guido was saying, we are sort of back to what Rousseau was saying in the sense of man is born free and everywhere he is in caves. And there is a situation where we have had Keynesian policies and they have failed dramatically during the 70s and the 80s when we had stagflation and so on. So today Keynesians are back, but what is the future that they see? In other words, we have these massive injections of liquidity to the Keynesian program. How are they envisaging that liquidity will be mopped up?
Well, the Keynesian program is not providing the market, injecting liquidities in the market, right? The typical Keynesian program is deficit spending, right? And again, from a technical point of view, it is superior to what we had, to the mere approach by central banks, who only provide credit, at least in conventional monetary policy. But again, it ultimately doesn't work, and that's what we are witnessing now. It doesn't work because we have a macroeconomic problem. And Keynesians, although they have this rhetoric, right, all the other guys are just microeconomists, and they don't understand the relationship that exists within the entire economy, cannot think of the system as a whole. That's precisely what they cannot do, apparently. I mean, lots of Keynesians have difficulties with this. And so the policies that they recommend make sense only for individual industries, but they do not make sense if you have a problem on the level of the economy as a whole, especially on the world economy. So what happens right now is that real resources are shuffled from some places of the economy to companies that are in fact bankrupt and that do not produce products that are viable, that can be profitably produced. So we are squandering resources as the next round, right? Because you still haven't solved the problem that you have invested. You've set up plants and machines and so on that cannot be profitably run. Right? So you have to do this on and on and on. So we're just impoverishing ourselves. And that's what we are seeing right now. Therefore, the markets do not calm down. Right? Because we are solving a little bit of problems on the one side only by creating more problems for other people. So that's macroeconomics 101. Precisely the lessons that Keynesians have not yet learned.
It bothers me that these presentations could have been made at any point in the last 10 years. They say nothing specifically about why the crash broke out when it did. If the Fed was expanding the money supply, which I take is what you mean, what did they show for the monetary aggregates? I don't remember reading that. Did the Fed's expansion of the money supply show up in M1 or M2 or M3 or any monetary aggregate?
Yeah, well,
and why didn't it show up in price levels?
Yeah, that's a very good question, and it brings us to the issue why the boom phase took so long without leading to a crisis earlier. And it has a lot of to do with the fact that the price level remained relatively stable. There are in fact two main circumstances that contributed to this result. So we had monetary expansion going on ever since we abandoned the gold standard in 1971. In the 1970s, this showed up in high inflation rates. Okay, and then starting from the 1980s, first of all, so there was more conservative monetary policy that is much less expansionary than before, but still expansionary. But we still had expansionary monetary policy all through the 80s and all through the 90s and into our present decade. And it didn't show up in inflation rate as high as in the 70s because we had globalization. Believe it or not, I mean, this increases productivity a lot and has increased productivity a lot. So you shuffle in all the cheap consumer goods coming from China and other nice places, and this neutralizes our expansionary monetary policy. Without globalization, we would have had higher prices. Without the expansionary monetary policy, we would have had a deflation. Right? The price level would have sank. Second thing, and that was equally crucial, was the collapse of the Soviet Empire at the end of the 80s. So then you get another huge chunk of people integrating the world economy, which they did not before. So you get the same productivity gains. And plus, you get now many new economies that absorb dollars because they are setting up monetary systems. They didn't have one before. So now they need dollars as reserves and so on. So they're absorbing lots of liquidity has been created in Europe and the US. Result for our is undeserved bliss for our economic politicians, right? So they should have earned inflation because they saw the increasing money supply. And what they earned was, by and large, stable price level, and so no increases in the interest rate in particular. So they had a good run. I mean, that's the reason why it took so long.
Well, which monetary aggregate would you look at to show quite a bit of expansion?
Well, you just look at, for example, at the balance sheet of the Federal Reserve. Right? That's an easy one, or the balance sheet of the German Bundesbank, now of the European system of central banks. You look at their the combined balance sheet, and you see the expansion every year. And you even see for M1, you see regular expansion of in between 5 and 15% from roughly from 1990 to 2005. And it changed only now in the crisis, because what happens in a crisis is that the banks go bankrupt. Okay, so then you have, out of the two components of M1, you have base money, which is produced by the central banks, and then you have bank money produced by commercial banks. Bank money supply collapses, and on the other hand, the central banks try to steer counter because they want to stabilize the price level, so they expand vastly the base money supply. That's what Doug mentioned, I believe, right? So they have increased their balance sheet by 140%. This didn't show up in a change of M1 that was equally significant, because you had a corresponding decrease of the bank money supply.
Yeah, banks increase or create money through lending activities, and banks aren't lending any money at the moment. The government's trying, or the central bank is trying to compensate right now. So kind of the central bank's balance sheets are growing, bank balance sheets are flat, but when you see banks begin to lend again, and I don't know when that'll be, there is, shall we say, a lot of timber to start a fire with at the Federal Reserve level.
Since we're living in a Fed world, is there any safe haven, any currency that doesn't work in the same system? Something you can still rely on these days?
What's investment advice?
Well, the ruling party in Turkey once promised a gold, was it gold dinar or something? They didn't deliver. Yeah, so Turkey won't be our safe haven. Switzerland is still pretty good, okay? And the Swiss can afford the luxury of pursuing a relatively stable money policy, even though the others won't be able to do the same thing, because they have a relatively small capital market. It's a little bit more complicated, would lead too far away. But so Switzerland would still be fine. And apart from this, I would also have a hard time. Gold? Well, but that's not, that wasn't the question. Of course, if you want to protect some currency that works, yeah, natural money.
Assuming gold is a currency, if you're going to put something in your safe deposit box or a hole in the backyard, I would recommend putting gold there rather than stack of hundreds, I suppose.
110 centimeters deep, and you need some, what is it, Blei? What was this? Blei in English? Lead. You need a lead protection around, because otherwise our friends from the IRS will find it.
Yeah. And buy firearms also.
And just to come back to the idea of greed again, I think it is very entertaining for me to see that the same guys who say greed was the origin of the crisis are now enlarging money sums, and so they are enlarging the object of greed. This is quite absurd to me. And if this is right, that a gold standard would limit the object of greed, then it would be maybe the only safe haven to pick this up the word, to limit greed as well. And based on this idea, my question is this: would it be a wonderful crossover strategy for all the libertarians to somehow join Hispanics or blacks or Afro-Americans and together with them demand all gold reserves being handed out to the people, and so to say, each American, and this is my question to the United States experts on the panel, each American wants to have his part of the Federal Reserve gold that is kept or lost where else, and then you have the propaganda sentence: as a free man in a free country, I take pride in the world, so I'm a gold donor.
Wow. Well, yes, we could do that, but I would, to use statistics, the probability of it happening would be zero. I think I just sold some gold, and I had to give the merchant my driver's license, and with my picture and my driver's license number, because he had to report to the government who he was buying gold from, and so the government keeps very close tabs on on who owns the gold, even though they own most of it. And so that's just not going to happen. And the government has gone through great pains for generations to control this stock, and so that they would kill us if we got too rambunctious.
Well, there's the old saying that the king hates gold, and mainly because it's the people's money. So I don't think they'll be passing it out to every individual American. But we could hope that it happened, and my hands are open and ready for it.
I mean, if I may just add this, you're talking about probability. We were talking in Germany about probability the last weeks and months, and nobody would have thought that, you remember 20 years ago, 1979, all the Western world boycotted the Olympic Games in Moscow because the Russians were in Afghanistan. And who would have believed in 1979 that 30 years later we are in Afghanistan? We are not fighting with Mujahideen against Russians, but that we are fighting against the Mujahideen to protect freedom. This is probability maybe not the only case.
The only way something like this could possibly happen in the U.S., I think, is if there were several acts of secession that broke it up into maybe 10 or 12 different republics, and one or two of them would go on the gold standard. And their economic success would be a model for the others that would induce them to imitate it, because they would become much wealthier societies than the other republics. But as long as we have this one unitary empire held together with nuclear weapons, that's never going to happen, I don't think.
As we all know, all over the planet, the governments go from debt into super debt, using the debt that's spending the gains. So I was very surprised today to read a letter to the editor of one of these very nice magazines, and there's somebody quoting Keynes that said, well, you should only do deficit, well, you should just stimulate spending, but only if you have a budget plus. You're already in debt, you shouldn't do it. So this is the first time I've ever seen anything like that. If it's true, why don't people bring this up? But it all sounds, quite against wherever you are in terms of debt, you must spend more. But apparently says we only should do it going out.
Well, I mean, Keynes himself was fiscally more conservative than most of his followers. Right? So initially, his idea was indeed that you use budget surpluses to accumulate for bad times, and you spend this money, and the other way around. But I mean, this never actually made it into the textbooks. Right? So what we learn in standard textbook Keynesian fiscal distinction between monetary policy and fiscal policy, this is never mentioned. So the idea is, as you have said, right, whatever your present level of debt is, you go into more debt.
But then you cannot say Keynes told us we don't.
Yeah, one shouldn't say. One should make the distinction according to a standard Keynesian theory or something like this, but not say Keynes said this, right? So, but that's also a distinction that the Keynesians themselves, the various sects, like the neo and the post and so on, that they themselves also made. There's a famous book by Lacan Rufut. I don't know how to pronounce his name. You know the Norwegian guy. Leyenhufvud. Thank you.
Axel Leyenhufvud.
Listen to him. Right on Keynes and the Keynesians. Where he stresses the difference, and was kind of the starting. The book was published in 1984, and it was kind of the beginning of a revisionist assessment of Keynesian theory.
It's like Marx and the Marxians. Well, the Marxians are very different than Marx himself.
There's the early Marx, and then there's the later Marx.
So my question would be to Frank. What is the power of the Fed in setting the target rate, target interest rate? Because we have seen at times that they change the target rate every week. So it looks to me as if they are reactionary from reactionary.
Yeah, they seem to, the Fed follows the market more than it sets the market. there's certainly some truth to that, but certainly during times of crisis, at times they've had to keep rates even as low as they have. They've had to withdraw funds, actually tighten to keep rates as low as they are. Otherwise, they'd go even lower. There was a time in late fall when there was so much crisis in the market, people were willing to accept a negative treasury rate just for fear to get most of their money back. And so the Fed was actually tighter than they would have been just to keep their Fed funds rate at 0.25%, 3/8, or whatever their target rate is. So you're right, they do tend to follow the market more than lead it, although it's through this balance sheet, huge balance sheet expansion that gives them the kindling to really create massive inflation over time, which hasn't occurred yet, because you have a massive asset price deflation in the banking system, which is keeping bankers from lending, and those are the two forces that are really in play at the moment. But eventually, banks are not going to be able to accept deposits and not lend them out. They have to do something with that money and earn a positive spread. So they're going to turn around and lend the money. The Obama administration wants them to lend. Everybody wants them to lend. Back to the previous point, no banker in town gets any kudos for being a safe, sound bank. You don't go to any cocktail parties and say, boy, I've heard your bank is very conservative. You hardly lend any money. That's great. That never happens. If you go to the Rotary Club, they want to know, are you making loans? Are you doing deals? That's where bankers get their strokes when they're going around town, and that's how they make their money. So eventually, banks are going to lend. I don't know what they're going to lend on. I think they're going to be scared of real estate for a long time, but they may have to be in place just to buy government bonds going forward, and that may be the next bubble that's created.
That's, by the way, also the reason why schemes for creating bad banks will end up in disaster. Right? The idea is to concentrate all toxic assets, that is non-performing assets, in one institution and clean up the balance sheet of the other banks. But then the question is, of course, what should they do then? Right? And, prudent bankers, especially in the present situation, will say, well, okay, that's fine. We are safe. We close the door. We make a bank holiday. We don't lend because we cannot really oversee the market, how it will be in 1 year or something like this. This, of course, will create an uproar, right? And so they would be pushed into lending more and, of course, into subsidizing projects that are not viable and projects that will not be viable. Yes.
Sorry, I have the Professor Hülsmann question. The previous leadership is very popular in and making predictions about the U.S. economy. And he's generally very pessimistic in the U.S. economy, more optimistic about the world economy. Because, for example, in regard to Europe, there's more savings in France and Germany and other places. He's also predicting a big inflation in the U.S. dollar. Given that the European Central Bank is pretty much following the Federal Reserve Bank in their interest policies, lagging behind 3%, well, it's a thing, it's probably significant. What would be your prediction for the Eurozone inflation? How big would it be and when it become? What would you say about that?
Well, I mean, in my book, I explained that there are very strong incentives for the monetary authorities of all the major currency areas to expand in unison. Because if the Americans expand and the Europeans don't, well, then this will, of course, entail a depreciation of the dollar exchange rate. So investments made on the U.S. financial markets would go sour. So all the money would be shifted over to Europe. Right? So you get very strong fluctuations in payment streams and so on. Therefore, it's a very strong incentive for them to keep the exchange rate, to stabilize the exchange rate. The only way to do this is to expand in unison. So short of hyperinflation, there's certainly no need to follow sister central bank into disaster, but short of hyperinflation, I would say yes, there's a very strong incentive that we should expect approximately the same inflation rate in Europe and in the US.
Yes, reading America's Great Depression by Murray Rothbard, I was struck by the fact that the initial reaction by Herbert Hoover papered over the cracks for a few years and got the illusion of having even a little worse of it. While at the same time those measures were destroying the economy. And at some point, I think it was 1933, it became apparent that there was a point that these green shoots were fake. Now it seems that we sort of following more or less the same game plan, and since the initial crisis in September 2008, measures more aggressive have been taken. We've seen a very rapid stock market in the US for the past few months. Green shoots have been very prevalent in the news. But at the same time, we as prosperity believe that they have destroyed the economy even further by their actions. So if they are reckoning between those two, the perception of reality is sort of indivisible. Is there any flaw with this analysis, or sort of agree with it?
No, yes, I would agree with this.
Makes sense to me.
I'm just wondering, with all this money printing stimulus and the creation of money, that people haven't already started to hedge against what seems like a highly likely inflation of a very severe degree. And why they haven't started getting out of cash yet, we haven't seen a bigger rise in the price of gold. Can you explain that, what that might be?
Well, I mean, the gold price is one of those indicators that authorities to manage. I mean, there's widespread speculation about manipulation of the gold price. I mean, whether you call it manipulation or not is a secondary question. The fact is that the monetary authorities and, let's say, the Treasury in general has a very strong incentive to manage the gold price. If the gold price moves steadily, increases steadily as compared to financial markets, of course, everybody has a very strong incentive to go into gold. And so there's an incentive to prevent this, right? By keep selling occasionally, making the market more volatile than it would otherwise be, and so on. Yeah, so I think that's certainly one factor that comes into play. Another factor is equally important, that is virtually nowhere discussed, is the derivatives market. And if you look at monetary policy for the past roughly 20 years or something, 25 years, the Fed switched to an inflation expectations target, okay, as measured by interest rate futures on the derivative markets. Now, it's only a short step from following this indicator to trying to manipulate this indicator. And of course, they have the wherewithal to do this. And it's in their interest to do this too, right? I mean, if interest rates rose as much as they should, given the monetary expansion that we have, it would be much more painful for all governments in the Western world, and would, especially in the present situation, create great difficulties. So there are different policies of this sort that they certainly pursue, and that create more difficulties.
Just to add somewhat, the gold price is heavily weighed in the futures market. And another indicator, there was actually, and may still be to some degree, a shortage of physical gold. If you want to go buy an American Eagle or a Krugerrand or a Canadian Maple Leaf in some cities in the United States, it was very difficult to find physical gold for a period of months, especially during the crisis. Wasn't reflected necessarily in the day-to-day, ticker price of gold, if you will, but the premiums have more than doubled for the average retail buyer, which tells me there's tremendous demand for gold at the physical level for the average person, but for those trading commodity futures, they tend to follow technical analysis and all this hocus pocus in trading that commodity as they do any others, and I think that tends to keep the price probably at a lower level than it would be.
Well, I know that again, asking for fortune telling or speculation, but as Professor Hülsmann ended his speech with saying that we should expect another crisis in 2013 or 2030. Okay, and this implies a lot of speculating, and also as we were invited by Professor Hoppe to come. Why don't we speak a little bit about the future, about those probable scenarios?
I didn't quite get the question. Why didn't?
I would like you to present us a certain your predictions simply. How would the situation develop until this 2013?
Well, okay. I got similar question after my talk, so I didn't want to give the impression that I think the present crisis is over, okay, and that now we have to wait until 2030. I think, in fact, that we haven't even reached the trough of the present crisis, because simply what we have been doing now is to waste time. And we've been plastering the economy over with spending programs and so on, all of which are designed to keep unviable, non-viable companies where they presently are, rather than abandoning them, cutting them, and so on. So we haven't reached the depth of the crisis, and this year, so we have all these huge spending programs. I don't expect the trough until before 2010. Okay, and then if history is any guide, we will need about 3 or 4 more years to get out of the crisis. Now, what governments always manage in doing is to prolong a period until you actually reach the trough. That's what we had in the 1930s, right? We have the protectionist policy with huge tax increases and so on. So all of this prolonged the time it took until we reached the end. I wouldn't expect a resumption, let's say, of a normal functioning of the economy before 2015. So this would be my rough guess. Right? And if we then have not changed the monetary system, which I expect, right, it's only a question of time until you run into similar problems. It will not be a dot-com boom, or maybe not a real estate bubble, but some sort of bubble will appear. So I mean, markets are infinitely inventive. Right? They will find something on which we have the next bubble. And 2030, well, this is not a forecast, right? It's just a rough idea. Well, if we are out of the trouble, the present mess in 2015, maybe this will drag on until 2030. I don't know. So, but then 15 years later, yeah, it seemed about right. And it could be the next one.
Yeah, I think it's relevant, I think, that Obama's $1 trillion so-called stimulus spending bill, most of the money won't be spent until 2010, which is an election year, of course. And so they're going to just shower the construction industry in America with hundreds of billions of dollars to buy re-election of Democrats. And that'll have an inflationary effect later after that. So in addition to the bubble, there has to be a super bubble on the way with all the printing of money that's going on in the U.S. No one knows when it's going to happen.
Yeah, I mean, all this clamor now about combining the crisis with ecological innovation, right? So I guess, you know, in 2002, when we just when the dot-com bubble had just burst, and our Keynesian friends, in particular, the recent Nobel Prize winner Paul Krugman, he called for a new bubble, right? So the problem for Keynesians is not the bubble. It's that the bubble ends at some point. That's bad. So if one bubble ends, then you create the next one, because it's somehow good, it's a great show, a lot of spending, and so on. So Krugman, in October 2002, in one of his New York Times editorials, he said, well, we need to have a real estate bubble now. And he got one. So next thing now, we will have whatever, ecological industries.
Yeah, I think we're going to have a bubble in green technology, right?
Can I also ask you to speculate on that? Mr. Bernanke shows us that the Parliament, nothing to worry about, because you've got a lot of tools in the toolbox which you can use on a situation under control. He's expanded the balance sheet and he's sterilized
by issuing bonds and therefore giving cash for cash and all. What do you think is next tools that they're taking? Why don't you have advertising which have been using for a long time to manipulate CPI? One very effective way of controlling inflation is to doctor the thermometer, obviously. You don't inflate and all that nonsense. I realize it's just speculation, what do you think when next? Box of tricks, I would say, box of tools is what he calls moving.
Well, some of the things have already started, and so they've been buying federal bonds. They've been started to buy, well, not in the US, but they might do this next, just corporate bonds. They might, there are various other weird ideas. For example, the idea of melting money, right? So you have Silvio Gazelle's scheme, but in fact it's older. It's an old mercantilist scheme, but became famous with Silvio Gazelle, who thought that you can encourage spending if you make sure that the money loses whatever 10% of its nominal value each year. So you have a $100 bill, and on the bill is written, well, next year in 2010 this is only 90. Right? So you clip it and so on. So therefore there's an incentive for everybody to spend as much as possible. Now this is absolutely crazy. Okay, it is crazy. Now this idea is now being seriously proposed by people who I thought were halfway serious and halfway for example, Gregory Menkev is the author of the main macroeconomics textbook. He's a Keynesian, but seems to be an okay guy. And then he comes out with this crazy idea. And Willem Buter, he's an economist at the London School of Economics, author of a column in the Financial Times, same thing. I mean, my impression is that these guys are just getting crazy. I mean, they don't understand what's going on. They think that they are so imbued with the Keynesian prejudice that spending gets us out of such problems, not reshuffling the economy, that you get such schemes. And to end it all, the more I hear Mr. Bernanke, Professor Bernanke, make such statements, there's nothing to worry about, the more I think that his term will be one of the shortest of all Fed chairmen, because he's in the process of losing any credibility. Because he's been doing this for the past 3 years, and at some point nobody will listen to him. And then we need a new Fed chairman. Bye-bye, helicopter.
There are even people in Washington that have been talking about another stimulus bill, so-called, but issuing checks to individuals in disappearing ink that will disappear in 3 months. So forcing you to spend the money, because they said the last time too many people paid off credit card debt or saved the money. They want to spend it right now. So they're actually talking about, is this technologically possible to do this?
Well, what they're doing in China actually is, and this wouldn't be a Fed policy, but in China their stimulus is they're providing coupons for washing machines and other appliances and to stimulate. So they're not leaving it to the individual, for fear that they may stuff the money in the mattress and save it. So they're actually just passing out coupons in China, and this is getting a lot of play on the financial channels in the United States as being a much better stimulus package than this idea of sending checks to people.
Yeah. One washing machine in each room.
So we should all become washing machine entrepreneurs and go to China, I guess.
Yeah. Have one in each room.
Yes.
One washing machine for each shirt.
Each level.
Yeah. Clothing shops, right? You buy a shirt and you get a washing machine. Thank you.